Thanks so much. Clap if you're learning a lot this weekend. Be the solution for the people in front of you. What kind of magic am I going to make happen today? Next up, offering their outlook on the state of the real estate market is a special panel of Dueling Economists. Okay, public school, slow down. From Freddie Mac and First American Financial Corporation. Oh my God, there's going to be a duel. Things just got real. To share more is moderator Jeanette Waller, president of First American Title Direct Division. Jeanette Waller, come on down. Where are you, girl? Thank you.
All right. Good morning. Thanks for joining us today. Really, really excited to be here. I'd also like to, just before we get started, this is the first event I've ever been at where there was no line for the ladies' room. So I'd like to thank you all very much for that. So I'm excited to moderate this duel between these magnificent brains here. And we're going to talk housing economy with Mark Fleming from First American Financial Corporation and Len Kiefer from Freddie Mac. I found out today these guys actually live on the same street and really don't talk to each other. So that was an interesting fact that Len shared with me this morning. So Mark is chief economist for First American. He leads a team that is responsible for analysis, commentary, forecasting trends, and the real estate market in general. So he's been quoted by the Wall Street Journal, New York Times, Housing Wire, and he appears as a guest on CBS, CNBC, and NPR. He's also a father of 3. He's very fit. He runs and bikes. But the most important thing that Mark does is that he makes beer. Can you tell us a little bit about the beer that you've been making?
I'm from Washington, D.C., so the leaves are starting to fall and the weather's getting colder, so it's Russian Porter time this year.
Russian Porter, very exciting. So Len is the deputy chief economist for Freddie Mac. He's responsible for mortgage market analysis and research and macroeconomics and forecasting. And he's also involved in analyzing policy issues affecting the real estate market. He has a lot on his plate. He's married. He has 2 kids. And when he's not coercing his kids to root for the Ohio State Buckeyes, who have a really good record right now, by the way, and the Kentucky Wildcats, not doing as well. He is super active on Twitter, so you should check him out on Twitter. He has turned economics into a form of graphic art, and we have no graphs and charts today, so hope that's okay. But it's pretty incredible, so you should check him out because you'll definitely be entertained. And Len just recently took a trip to Asia. Will you tell us a little bit about that trip?
Sure. So I'm, an economist. I'm a numbers person. Love to dig into my spreadsheets and computer codes. But it's nice to be able to get out to the world and kind of see different things, get different perspectives, see what's actually happening out there. So it was really eye-opening to get the chance to travel. Really fortunate to be able to do that. Kind of learn about what else is going on in the world, particularly when you're thinking about the economy. Sure. What's happening in Asia has been big on the news and likely to continue to be. So getting some perspective there is, I think, very helpful.
Yeah, cool. So, as I said, these guys are great economists. I am not an economist, so I've asked them today to keep it kind of, low-key and light on the terminology so that we all can actually understand what they're saying. So we're going to get started.
Jeanette, did you know that an economist is someone who solves a problem that you didn't know you had in a way that you don't understand?
That's well said, well said. Okay, so first, I think that this audience would really like to know your take on the LGBTQ housing economy and how that may differ from the larger housing economy. So, Mark, I'll start with you.
Well, I was reading the NAGLREP report this morning before coming in here, and there's a great map that shows where the association chapters are, and it kind of really highlights the bi-coastal nature or the lack of anything in the center of the country. So this idea of where the community exists and the types of places that they live, generally more urban. This creates affordability problems, although we'll talk about affordability in a couple minutes. But I think one of the most interesting things is there was a lot of discussion about sort of home ownership and the desire for homeownership. And I always make the joke, as an economist, we have two models of how someone chooses to become a homeowner. And the first model is this sort of complex idea that says, you're renting in a home and you're paying, $1,200 a month for your rent, and you're going to go out and you're going to take the house price and you're going to convert it into an implied rental rate. You're going to take a net present discount factor. You're going to take into account the tax. No. Who knows what a net present discount factor is? That's not actually how we operate, right?
I was about to call you out for
that model doesn't work. There's really a more simple model, and our research shows that it basically is a two-stepper. And the first step is the decision to want to become a homeowner. And then the second step is once you've decided you want to become a homeowner, then you figure out financially how much you can afford to buy or not. And Tammy before has mentioned, like, the single largest issue with becoming a homeowner isn't necessarily the monthly payment, it's the down payment that's always the problem.
Right.
But that first stage, we go and do all of this research and study, what are the real driving forces, and it's really lifestyle choices. And in the data, we find that being married and having kids are the two most important factors that drive that decision to become a homeowner. But it strikes me that, when I go and look at the data, for the LGBT community, like, that flag, being married or not, is actually only something that was technically able to have been turned on in the census data in the last 4 years. And so it's not really, I think, about physically being married and getting that, marriage certificate. It's about the concept of, settling down and having a stable partner or something like that drives that sort of, quote, more broadly speaking, sort of marriage decision. And then really getting into wanting to become a homeowner. And then you start worrying about the finances. And so I would argue that as an economist and someone who works with data, like, I have very poor data insight into the ability to really understand and research this community because of things like that marriage flag is useless for this community.
Just one point I want to make is just because this group of folks is getting married based on the party last night doesn't mean anybody's settling down. So,
Right. Yeah. There's a reason why I ran 5 miles this morning. It wasn't because I liked to, it's because I needed to get rid of the headache that I had when I woke up.
So Len, do you want to add anything?
Yeah, Mark alluded to the map of the NAGLREP chapters that was in the report, and one thing that struck me about that is the geography of where those chapters are located are virtually every single one of those markets is a higher cost than average market in the United States, along the coast, but even the interior markets, larger urban areas. And those areas are places where house prices have just skyrocketed, rents have skyrocketed, and the issues in housing that we talk about broadly, I think, are even more acute in those places. And those are the places where, risks of potential, volatility, as we saw over the last year in California and parts of the West, I think are even more elevated. So a lot of the things that you might get from looking at a national statistic, I think, in terms of volatility, in terms of where price and risk may be moving, where to understand really what's driving those market fundamentals is going to be exceptionally important for those communities, because those are the places where, sort of as a housing economist, those are the markets that we're really looking at and trying to understand what's going on there. So abroad, sort of things that may be true nationally are not necessarily going to be true for those communities, and so understanding those is of critical importance.
Okay.
But can we talk about affordability and sort of this concept of a high house price? Because I think, excuse me.
You mean in California?
Well, I mean in many markets, Washington, D.C. as well, but definitely you can pick on California since we're here. I don't believe it's about the house price. People don't really buy based upon the house price. They buy on how much per month. And then you convert that into how much house does that turn out if you can spend $1,500 or $2,000 a month. And what really drives that is the interest rate, your income and the interest rate. And so one of the main reasons why house prices have been growing so quickly over the last decade is because interest rates have been falling. And we make this measure called house buying power. And it simply is you're just monitoring the change in income and the change in interest rates. And the simple argument is even if your income doesn't change but interest rates go down, what can you buy more of? Home, right? And over the last 10 years, interest rates coming down to 3.5. The old adage in the real estate and mortgage community was you can probably afford to borrow roughly 3 times your income. Yeah, but that was when rates were 7 to 10%. When rates are 3.5 or 4%, that multiplier is like 5 or 6. So a 150, I'm just preaching to the choir here, right? You guys all do this math in your head. A $150,000 or $200,000 household income, 2 people earning, that converts into a $1 million mortgage. So if you can afford $1 million mortgage and you go into a market that doesn't have a lot of housing supply, let's say in San Francisco, you bid that price up against everybody else. So the price rise is the result of extreme buying power. When we measure house prices in this sort of buying power adjusted fashion, we find that because of this, the buying power being 4.5 times higher than it was in the year 2000, if you adjust for that fact, housing is actually more affordable today than it was in 2000.
But Mark, how long do you think we can have that continue on? You know, we've at Freddie Mac have been running this mortgage rate survey for almost 50 years now, a better part of 5 decades, and we've seen this sort of long-term 40-year decline in interest rates. And sort of every economic cycle, we see the 30-year fixed-rate mortgage come down a percentage point or two from where it was prior, right? In the early 2000s, it was at 8% at the beginning of the century, and then ratcheted down to 6%, and now we're down to under 4% again on the 30-year fixed-rate mortgage, which, again, in the short term provides a huge boost to buying power. But are we going to be seeing that down to 2% or under 2% in the next cycle?
There has to be a floor, right? Because the mortgage rate is tied to the 10-year Treasury bond, sort of what you would do with the money if you were going to put it into the mortgage market, invest in a risk-free asset, and that is, the 10-year Treasury is historically low, so that helps. I laugh because, I'm an economist, I'm supposed to forecast things, right? You never get it right. That's the one thing I can guarantee you is I will not be right. In fact,
are you about to give a forecast?
I'm about to give a forecast. I'm
okay.
also going to break the other rule, which my advisor told me in grad school was either say when or by how much, but don't do both.
There's no press here.
So
anything,
here goes both.
Okay.
I predict that interest rates will go up in 2020. Now, if you go and look me up, I've been saying that at the beginning of every year for like the last 5 years. Eventually, I'm going to be right. Glenn, to your point. To your point. But this actually creates a bigger structural problem is, roughly 2/3 of all American households own homes, and roughly half of all American households, those who own homes, have mortgages. There's a share of people who own free and clear. The vast majority of people who own homes with mortgages already have somewhere around a 3.5% to 4% mortgage. Which means every time rates come back down there's fewer left out there. At this point, I'm kind of wondering, what rock have you been hiding under that you haven't refinanced yet? Right? This is going to create a huge problem going forward because you are a homeowner, you got your 3.5% mortgage, you're just going to sit tight. That's 2/3 of American households. And then you got this poor old young millennial first-time home buyer saying, please, please, I'd like to buy a home. And everyone's like, hey, I'm not going to sell you mine. And Len, to your point, over the last 40 years, the declining rate environment has created this turnover where you move up and you make space for that next guy to come in. But when rates go the other way, or even just don't keep going down anymore, we're going to create this big sort of structural lock-in. We already see it in tenure length. We measure tenure length as the average amount of time people live in a home. Prior to the recession, it was 6 years. It's now over 11 and rising quickly.
Wow. Anything to add to that?
It is a dismal science for a reason.
Well, I would just add that this lock-in is not just rate-driven. A lot of it has to do with just the fact that we're not building enough homes to match the demographics, right? And so the fact, particularly in those coastal markets where the house prices have been rising and you sort of see rents up and you see job growth very strong, the ability of supply to keep up has been very, very poor, right? And so that just puts pressure on those marketplaces. And so folks aren't going to move out of their home to move up if there's nothing to move up into. Right. And so folks are going to hold on to those. And then the first-time home buyers or potential first-time home buyers are really going to struggle in that environment. And that's exactly what we've seen. And unfortunately, it's probably going to persist, over the next couple of years. I don't see it clearing up anytime soon.
Len, this is a terrible duel because we seem to be agreeing with each other far too much. Yeah.
Okay, let's talk recession.
Recession. So we have to give another forecast,
yes.
Right? Well, the joke about economists asked about recession somewhere in the next 18 to 24 months. You can always make that answer in the next 18 to 24 months. Look, if you watch CNBC most people probably don't, but I'm supposed to do it because of my job, right? Get up in the morning, you watch CNBC, and yesterday it was a perfect example. A relatively unknown manufacturing survey declined by a precipitous amount to a 10-year low. We're saying that we're not manufacturing very much here in the United States anymore, or that's a segment in decline. And the stock market freaked out, and every CNBC analyst said, this is the clear sign of recession. I'll make two simple points. One is 70+% of the US economy is driven not by the manufacturing sector, but by the consumer. And the consumer is still feeling pretty confident, and their incomes are growing, and they're spending more than they've ever spent before. So there's that. The manufacturing sector is actually shrinking as a share of the economy, right? We don't really manufacture very much stuff here, much as some might try to believe or try to make it happen politically. We're not a manufacturing society or culture. That's being done in other places overseas, like Asia, and well, in some places still like Germany and parts of Europe. Expansions don't die of old age. And so you look around the landscape and say, well, what exactly is there that would cause a recession? And I think it would be something of our own doing, like a trade war, right? We have, theoretically, that in our own control to avoid if we wanted to, but that would be a certain situation. And then more broadly, I think the bigger risk simply is global economic slowdown. So in that case, we don't have control over that per se, although through trade wars we might influence the pace of global economic slowdown. That's happening. It's not a guarantee that just because the rest of the world slows down, we have to go in recession, but it does guarantee that we will probably grow more slowly. Okay. And the challenge there is, well, we're not necessarily growing that fast right now, although one might argue what is the right rate, what's just right, Goldilocks style for growth in this country, but we're at 2%. So, some estimates say that trade wars would cut 1% off the GDP, so that takes us down to 1%. Global slowdown, when you've only got 1% left, that could do it. So I feel like, you can't really, it's really all in our control, and that's the challenge. We could continue to grow quite successfully, probably around 2%, unless we do something stupid, basically.
So, I do a lot of analytics, and one of the things that analytics people like to do is look at a dashboard of a lot of statistics. It's not as exciting. It doesn't look like a rocket cockpit. It's like a Excel spreadsheet or something with some numbers in it. But if you look at a variety of indicators across the U.S. economy, things have started to flash, not red certainly, but certainly yellow and yellowish orange in terms of where sort of the economy may be headed. Right, and so there's the yield curve inversion, all these things in the financial markets, the manufacturing data that we've talked about, and folks are getting more and more nervous about the future prospects for the economy. I agree with you that we have to think about what's going to be the trigger. It doesn't seem like any of these incremental single things are enough to sort of drive us into recession, but the preponderance of evidence is starting to mount in my mind, and so maybe it's because I wear a risk hat a lot and think about things from a risk perspective, but it certainly is not, I'm feeling the U.S. economy is much more vulnerable than it has been in this long expansion. Yeah. And sort of the odds of recession are certainly rising. If you stick these indicators into statistical models, you get something like 50%, which is a perfect economist forecast. You flip a coin.
On the one hand, and then on the other. Yeah.
But I am, increasingly nervous about the prospects for the economy. While, again, the baseline, okay, I think we'll muddle through. But, it's hard. You're getting more and more of these indicators that become harder to ignore all of them.
It's almost a self-fulfilling prophecy, right? Because it's so heavily driven by the consumer, and if the consumer decides not to continue to spend, then it's almost guaranteed. Well, what could cause the consumer to do that? Oh, watching CNBC for starters, right? Like, don't watch CNBC. If we just told everybody, don't watch CNBC when they're freaking out about some esoteric index, we'll all be fine. But, the chicken and the egg problem is we get scared, we stop spending, and we've almost now guaranteed that it will happen.
There is a real difference between the consumer and business, but one area in business that makes me a little more optimistic is on the housing side, because amongst all of the sort of manufacturing and other places, we've seen a lot of negative news, but housing remains very, very positive. And if you look at sort of home builder sentiment, and they're looking at things that we may talk about in terms of demographics and forces driving the housing market, they remain upbeat. And so that, I think, is one sort of area where the economy sort of has some good news there, and actually, I think, potential for some more upside, whereas some of these other areas, harder to see the upside. But we're in the housing sector, I think, actually, is a pretty strong place in the economy, should bolster us, and might be enough to sort of help us muddle through these next couple of years.
So interesting. So talking about a potential recession, we know we're going to be in a rising interest rate environment. So you recently had a blog post out there that said you think the housing market can still do well.
Yeah.
In that environment. Talk a little bit about that.
So because of all this talk of recession, we went back and looked at the housing market and said, how does the housing market fare in recessionary markets or rising rate environments? And what we found was, setting 2007 to 12 aside, that's the one exception, I suppose, that under most recession scenarios, house prices slow their pace of appreciation, but don't necessarily go negative. So you don't actually get price depreciation, you get less appreciation. And then you also get, well, clearly a slowdown in sales. People generally don't want to run out and buy the most durable good they're ever going to buy when there's all this sort of, I may or may not have my job. So the main impact is really in the slowdown of sales. But it's not that sales go to zero. I mean, so instead of selling, we're at a run rate of what, 5.5, 5.6 right now, which I think is just about right for the pace of existing home sales based upon demographics and everything else today. A recession would cut us down to 5.2 or 5.1. So you have to set aside, obviously, the experience that we had in 2007 through 12. That was a housing recession or a housing depression that caused a financial crisis and the whole thing unwinding. But generally, under most recessionary scenarios, it's not that bad. Now, that said, to Len's point, what is the factor that kicks the recession off? And if that happens to be particularly driven in a local market, I'm thinking of like the Texas oil patch crisis, right? So if you have a collapse of a particular industry and markets that are, heavily predicated on that industry, then of course it's a more meaningful decline. But from a national perspective, we don't necessarily see big impacts on housing markets when recessions happen. And in fact, it takes two things to tango with a foreclosure. And the first thing is something has to cause your inability to pay your mortgage. So becoming delinquent, recessions can do that. Delinquency rates rise. But going into foreclosure then requires that you don't have equity in your home. Because if you had equity, the mortgage lender would say, please sell your home, pay me back, and we're all good. Of course, in the last crisis, the dual triggers both hit. But right now, American homeowners have more equity than they've ever had. And so you'd have to wipe all of that out before you actually got any delinquency translating into foreclosure risk. And it's really when foreclosures start piling up and then blighting the neighborhood, and all, that's when the housing markets unravel at the local level.
So do you think then that home pricing is going to remain kind of the same?
As Tammy was saying, at the 30,000-foot level, home prices are have appreciation slowed earlier this year. It's now picking up pace again because of this supply. We stimulate demand relative to tight supply. Prices go up. We talked about that a little already. But when you break it out by price tiers, you see some very different dynamics. So the high-end price tier, particularly the very high-end price tiers in very specific localized markets, there's sort of a significant collapse, actual price declines in many markets, like in places like Connecticut and Greenwich and Newport Beach. My CEO's from Newport Beach, California. He's like, Mark, your models aren't saying what's happening here. I'm like, yeah, but Dennis, you're like a microcosm of the world. And they're being impacted by the SALT tax, the changes to the tax code, right? Predominantly. But at the bottom end of the market, you've got a completely different story because no supply, all this first-time home buyer demographic demand coming into the market, nothing to buy, and there's tons of bidding pressure and tons of upward pressure on prices still in that segment.
You agree? I'm looking for a fight here.
Looking for a fight? Oh, no.
See if I can come up with something that you would say no way to.
No, on this issue, I think that there's just, when you're talking about sort of where sort of housing is in the cycle, and we're asked to do these recession scenarios and plan out sort of what might it look like in a recession, Len? Be a doom and gloom. And so as economists, I'm like, get a big grin because that's sort of what our training is and sort of being dismal about things and thinking about how that could play out in terms of the U.S. economy. Again, because we have sort of such tailwinds in the housing market, it's hard to see how we have a big drawdown like we had. Certainly nothing like the Great Recession, but even anything like a typical recession in the United States. In fact, if you look back in 2015 and 16, the U.S. essentially had a manufacturing recession in terms of contraction in activity. We may be seeing the same thing happening right now, whereas housing continues to post pretty solid gains. Again, I think a lot of that has to do with the solid demographic forces. Mark quipped about how hard it is to forecast, and forecasting interest rates and prices is really tough. So I've been trying to get in the business of demographic forecasting because while I can't tell you where the 30-year mortgage rate will be next year with much confidence, I can pretty much tell you how many 27-year-olds we'll have in the United States because I can look at how many 26-year-olds we have this year. Okay. And sort of looking at that sort of...
man, of course you can forecast how old you're going to be next year. That's easy.
But you look at the demographic profile, and that gives you just this huge sort of tailwind of a lot of first-time buyers showing up in the marketplace, a tremendous amount of constrained households. One of the consequences of the sort of really, really, really recessionary levels of building for a decade in the United States, first it helped clear out some excess inventory early on, but now we've had sort of such low levels of building that you have tremendous pent-up household demand. Young adults have been unable to form households, become homeowners at the rate of previous generations, and that's just providing a huge potential sort of growth there if sort of the market can take off and sort of gradually sort of build and bring more supply on, and that I think will give us sort of a bulwark there.
I have a point of contention.
Bring it.
So, all cool, but for one problem, which is that all these homeowners are old and aging in place.
Yep.
And they're just not, well, the other issue is in the old days, you aged in place till about late 60s, early 70s, like the silent and older baby boomers. And then you aged out of home ownership. I don't know how you want to describe how that might happen, but let's just keep it clean here. You age out of home ownership, hopefully not in a casket. And the problem is that they're not aging out. So, you've got the baby boomers, a pretty darn large generation. Technically not the largest anymore because millennials are larger. But, the housing story is, to me, as well as the economic story, is really a demographic story because what is this huge baby boomer generation doing? Their home ownership rate's over 80%. Mm-hmm. And they've all got the 3.5% mortgages, and they're all sitting pretty, and we're just not going to move. And meanwhile, you have this slightly bigger generation showing up, becoming a much more important economic force as they age into working, also being more educated than any other generation before them, which gives them good incomes, which likely makes them more able to afford to buy homes with nothing to buy, and we kind of just get stuck. And that's what I worry about. That's what keeps me up at night, is that the housing market story is a demographic story. I think it could be really difficult to find homes to sell unless they're new built, purposefully targeting the first-time home buyer, because everybody else is just going to sit back and be like, I'm good.
I'm not selling my house.
That's depressing, isn't it?
All right, so tell me now, what do you think the most interesting trend has been for 2019 and maybe going into 2020?
So, I'm from Washington, so I'll take a slight political turn here, and I say it's the complete misunderstanding of politicians trying to create housing policy that it's a supply problem and not a demand problem. And if you think about almost all of our housing policy, particularly at the federal level, is about trying to tweak demand. Tammy mentioned the FHA changes. That's going to tweak demand. Well, you tweak demand, and again, there's no supply. All you're going to do is bid up prices. And so the solution to getting more people into home ownership isn't about trying to make mortgages less expensive. Isn't about trying to do a 1% down payment instead of a 3% down. It's not about that. I mean, sure, that helps the demand side, but where our problem isn't on the demand side right now. It's on the supply side. And then, so where is policy around supply generally driven? At the local level. And at the local level, it's all about trying to restrict supply. The research actually shows that the zoning and regulatory requirements are worse the higher the home ownership rate and the more expensive the housing. Because we're all really smart when we act in our own independent fashion. It's like, hell no, I don't want that happening in my backyard because I'm trying to protect the value of my housing asset. Is probably my largest asset that I have, and I'm trying to protect it. Now, rightly or wrongly, whether you believe what's going to change might actually, in many cases, benefit your home value, but don't want change, don't want risk, don't want it in my backyard. What's the largest lobby group in the United States? Not the NRA, not the NAR, they're pretty close. It's the 2/3 of American households that are homeowners. They don't have an organization in Washington, D.C., but what happens at the local zoning board when there's a proposal for upzoning of something? They show up in droves. And so how do we fix a problem? You can't do it with federal policy that fundamentally, Len, you've made this point a couple times, we haven't built enough homes by a long shot, and we need to build a lot more, and nobody is letting us do it. And that's, California is kind of the poster child for that problem, actually.
So, we talked about rates had been falling. Interest rates actually rose a bit in 2017 and into 2018. And that actually had a pretty cooling effect, and particularly on the coastal markets. We saw sort of housing really, really slow down. And then early in the year, I was really concerned, thinking, is this a ski slope down? Are prices going to continue to plummet? Is this going to be a major correction? Or are things going to stabilize? Fortunately for the housing market, interest rates came back down, and we saw sort of housing, I think, starting to get its legs back. And there's a lot of confidence there. Talking with folks in the building community are feeling more optimistic. And so if they're feeling optimistic, they may start building. There's a lot of things going on in terms of zoning around the country that might help sort of unfreeze things and get the market sort of moving again. And so in the sense of this development of sort of housing, I think, becoming a tailwind for the economy, it has been a drag in 2018 and for the early parts of this year. It's actually, I think, going to provide a boost and give us some strength there over the next couple of years. And that, I think, should be a really good sign. And that was, I think, to some sense, we haven't seen many cases when interest rates rise. To see how that impact of what Mark was alluding to, how that payment is affected by that mortgage rate, is something to watch for and have to think about if you're right and rates actually do rise.
Well, it's not a really good solution, but one way to cool the imbalance between supply and demand would be for rates to rise, and for that, what I think you're alluding to is we discovered that millennial first-time homebuyer is quite sensitive to interest rates at the moment. Although, I mean, you're worried about a 4 or 4.5% mortgage, and oh my God, that's astronomically high. Like, excuse me? What about 6, 7, 8, 9, 10? Oh, and by the way, just as a simple counterfactual point, in 1981, when the interest rate was 18%, people still bought homes. So, I mean, it does change the numbers, but this is a cool place. This is a cool market to live in because it can't be outsourced and everybody needs it, and that will never change no matter what the interest rate.
Okay, all right. So, what do you think the biggest misconception is about the economy today, just in general?
You want to start, Len? Because I've been starting.
Yeah, I think it depends on who you're talking to, but I think there's a lot of the folks that are looking at sort of some of the CNBCs or other news outlets that are reporting, these dire sort of stories about sort of how, the market is actually trending. I think if you look at broader sort of hard economic data, in terms of spending data, if you look at actual, activity, it remains pretty robust. And so there's this real dissonance between survey measures, forward-looking measures, things that are tied to, the political cycle, things moving up and down, a lot of sensitivity and volatility there. Whereas in the broader economy, it's pretty steady as she goes. And sort of housing is sort of a boring story about demographics slowly moving, people aging up, buying homes, providing sort of solid, demand there. But I think it's actually that boring story is a good story from the sense. And so people that are chasing the headlines and looking at all this volatility may not realize that we have this sort of this undercurrent that's sort of providing sort of strength in our the broader U.S. economy, but particularly the housing market. And so the folks are overreacting to some of the negative headlines that is sort of driving sort of the news cycle as opposed to what's actually happening in the economy.
It's like the old Wall Street versus Main Street political. I mean, all that stuff on TV is about Wall Street and them getting all angst about that, whereas Main Street's just kind of chugging along. I think for me the thing is, well, we're all complaining because somehow 2% GDP growth is not enough. And if you take a longer historical perspective or view on, we had throughout the middle of the 20th century, 3, 4, 5, even 6% coming out of recessions in the middle of the century, GDP growth rates. But, and so I think there's this sort of perception that we should be back to that. I mean, even politically, people are saying, oh, we need to make it 3 or 3.5%. That seems to be right. And the truth of the matter is it's not. And 2% is just about right for where we should be. The anomaly, if you will, was the middle of the 20th century when GDP growth was much higher. And that was predicated on 2 simple things. One was a large increase in the workforce. So, GDP, gross domestic product, it's the dollar amount of stuff we create in the economy. How do you create stuff? Well, you need land, labor, and capital. The fact of the matter is we had a huge increase in the amount of labor entering the workforce. So you had all these people coming into the economy so you could make more stuff. And then also in the middle of the 20th century, you had big gains in productivity. So each one of those people coming in and working was coming into more and more automated and more productive generally manufacturing-oriented businesses, and they were making more stuff per person, so GDP was really high. Then those things faded, and we've gone through a relatively slow sort of labor force expansionary period, largely demographically driven because Generation X, my generation, were just not big enough to matter, it would seem. And, but that is likely to change, millennials as they come in, so we'll get the tailwind of demographic growth again. But what we don't see still is those productivity gains, and or we haven't historically. And you sort of say, well, what was the big invention and what's the latest invention that's likely to generate productivity gains? And clearly, you say, oh, it's the computer. And I would argue it's not actually the computer. It wasn't even actually I had a computer when they first came out, and it was a glorified typewriter and calculator, right? It's when you plugged it into the wall called the internet that things really started to change. But it's actually now this sort of the AI revolution. I think that's really where we're figuring out how to really make computers transform the way we do things and transform the way our labor does things to make them extremely more productive going forward. So I would argue that 2 is just right now, but over the next 10 years, we have some very, very strong positive tailwinds for an acceleration in GDP growth, regardless of all the politics and what everyone else might try and do to it.
Interesting. So we have about 5.5 minutes left. Maybe we'll take a look and see if anybody in the audience has a question that they'd like to ask. Anyone out there? I see a hand in the back. You can stand up.
I've got a mic. Hold on, Tim.
Oh, great. Thanks.
How would you address the focus of shareholder focus for the corporations versus consumer and employee focus?
Oh, that's an awesome question. The focus of the corporate focus on making shareholders happy relative to employees, paraphrasing what you said.
Okay.
Depends on the kind of society you want to live in, I guess. So under pure capitalism, that's what you do, right? The owners of the company, the shareholders, they want to extract and maximize rents, that's profits. So that's what you're supposed to do. I think there's an interesting long-run change that's happened, that there was sort of this an unspoken contract between labor and the owners of capital, shareholders, throughout most of the 20th century, that was sort of saying, yeah, we're going to treat each other fairly. Part of it was like the unions sort of forced it. You can think about unionization forces the organization of labor to force the owners of capital to give them some share of the rents, the profits. Another way to say it. So the weakening of trade unions over the second half of the 20th century basically allowed for the migration away to those rents not being shared as much by, and are now accruing mostly to the owners of capital. In addition, our economy itself is migrating away towards, businesses and industries that are more predicated on capital rather than labor, right? Like Google and Facebook and Instagram and Uber, not the people who work for Uber, but the Uber platform itself. All of these things, high levels of technology, not a lot of people. I'm a big Scotch drinker, and I went on a Scotch tasting tour in Scotland a couple of years ago. We went through this beautiful factory, and there was not a human in sight. And they're like the second largest Scotch maker in the world. There's no humans in the distillery. There's 2 engineers watching computer screens in 8-hour shifts 24/7. And I asked, well, that's 8 guys, right? And how many before? 130 before automation. And so to the point of this AI, that's making those 8 engineers extremely productive if you think about how much output they can create. Mm-hmm. But the dynamic of the importance of capital as a factor of production is just accelerating more and more. And if you're an owner of capital, you're the one who's going to accrue the rent benefits. But what we see as a result of that is faster increased inequality within our society.
And there's another factor, Mark, that's very important in this, is that a lot of research economists have been looking at how competitive markets are in the United States and across the broad industries. And we found that the U.S. economy has seen a decrease in competitiveness in the sense of more monopoly. So you think about sort of we have these great breakthroughs in this artificial intelligence, there's going to be these huge gains. Who is it going to go to? We have a competitive marketplace, that's one thing. But I think a lot of economists have made the argument that many of these marketplaces are not nearly as competitive as they were, in prior, mid-century, and that has led to some of this sort of factor in terms of, the distributional effects. And I think it's an important topic. You're seeing it debated in large scale, so I think that's going to be continuous. It's probably only going to become a bigger and bigger issue over the next, few years.
The fancy economics term for why Facebook and Instagram and Uber and Lyft work is agglomeration effects, right? They work because you have everybody is on the same platform. But that forces this concept of monopolization to happen, because it's hard to compete if you don't have that big platform, because no one else is going to want to join you.
So you guys have disagreed on one thing the entire
Damn
time I have been up here. I don't know if we could really call it a duel.
Are you a Redskins fan?
Well, no.
Oh, shoot. We can't even disagree on that then.
Okay.
I grew up in Cincinnati, so I'm a Bengals fan, so I've just capitulated entirely. So go Bucks, and I'll.
We can duel over the Cincinnati who? They have a football team?
Anyway, we have one more question over here.
Thank you, Jeff. Hi, my name is...
There's one in the back before you, right?
So sorry.
Sorry. Hi, my name is Jeremy Schachter. I'm a mortgage lender in Phoenix, Arizona. And I find it interesting, the Danish bank with offering negative mortgages. And if people don't know what a negative mortgage is, it's that the bank actually pays you money to get the mortgage. And I hear that other spots, especially in Europe, are going that way. And I'm curious because Mark said the rates are going to go up. I think Leonard said the rates are going to go down. My indications say the rates are going to go down. Do you see negative mortgages happening in Europe and then maybe in America?
So let me start off on that. This is a really interesting topic. When I was doing my research or my schooling in graduate school, one of the hot topics of debate 20 years ago was, low to negative zero interest rates in Japan. And a lot of the academic literature was like, oh, that's a very, very academic case. It's an edge. There's special circumstances. We'll never see that, in Europe and the United States. And now we're seeing it across Europe. I think there's a likelihood that we'll see it in the United States. There is a question about whether or not, because of the special role of the dollar, that we could see that. But I think it's definitely on sort of our radar screen. We have to start realizing that's a possibility and think through what the implications of that would mean on the mortgage space. So that's a really special case, but I think it's, that likelihood is a lot higher certainly than it was 20 years ago from an economist point of view. Economists are the folks who have to look and see something that they see out in the world and figure out debate, for 20 years whether or not it's theoretically possible. But we've already seen it, so.
We see it, so it must be possible. This is a space that just really makes my head hurt. I don't really understand why. I understand technically, theoretically why it should happen, but I don't understand why people would actually choose to take a negative interest rate. There's two things. One is fundamentally low-rate environments. More broadly, it's, if you go back to the, what's driving that stagflation, that low Japanese rate, the low rates that we're seeing across Europe and here today, is that we have globally excess savings. So if you think about, in order to think of the interest rates as basically the price of money, right? And so we have all of this cash, and we want to savings in the global economy, much of it being sent to here because this is a place where you can get a non-negative return. So you have this excess savings pouring into this country. And then the demand to invest that savings, what's referred to as capital expenditures. Two things there is, one, with all the uncertainty around slower economy, recession, trade wars, and everything else, it's like everyone is hesitating to make big capital expenditures. And two, there's been a shift, sort of what I was talking about with the AI, there's been a shift to the types of things that you would capital expend on. You're not going to capital expend on a factory so much anymore today. You would do it on cloud computing, but the problem there is a dollar spent of capital expenditures on cloud computing is extremely efficient. So the efficiency of our capital expending is much better than it historically was. Low demand and efficiency of that expensive dollar, tons of dollars made available, you get this extremely low, they refer to it as the neutral or natural rate of interest is like supposed to be roughly around 1 to 1.5% here in the States. That's what makes the risk of a negative interest rate possible. Mortgage rates, though, on the other hand, to get a negative mortgage rate, one, you would have to perceive that the mortgage is actually more safe than a 10-year treasury, because if you think about it, I can invest in the risk-free asset, or I can invest in a modestly riskless asset. But now we're saying we're putting no risk on credit or interest rate risk whatsoever. And on top of that, we're not paying, you said you're a mortgage lender, right? The mortgage rate isn't just about risk, it's about people getting paid their little slices of the pie to originate the mortgage, right? Think of the servicer. So all of a sudden, these folks aren't getting paid either. I think the more likely outcome if we get into this world was you wouldn't lend because you're not going to get paid than actually take a negative mortgage rate.
Well, we're out of time, but Mark and Len will be around, probably dueling somewhere else in the room here. We'd like to thank you all for your time and attention today, and thank you, Mark, and thank you, Len.
Thank you. Thanks, Jeanette.
That was a duel, y'all. Dang.